Now let's look at some of the problems at the end of chapter 1. I wanted to start out with practice exercise 1-1A. It's on page 29 of your textbook, and it says on June the 10th, Easy Repair Service extended an offer for $95,000 for land that had been priced for sale at $118,500. On August the 2nd, Easy Repair accepted the seller's counteroffer of $105,000. On August 27th, the land was assessed at $80,000 for property tax purposes. On April 1st, Easy Repair Service was offered $125,000 for the land by a national retail chain. At what value should the land be recorded in Easy Repair Service's records? Well, the land should be recorded at $105,000, and this is the cost concept. Land should be recorded at its actual cost to Easy Repair Service. It doesn't matter what the other company wanted for the land. It doesn't matter what it was assessed at or what somebody else offered for the land. It comes down to exactly what did Easy Repair Service pay for the land, and that was $105,000. Okay, next let's look at practice exercise 1-2A, also on page 29. Shannon Cook is the owner and operator of Galaxy LLC, a motivational consulting business. At the end of the accounting period, December 31st, 2011, Galaxy has assets of $800,000 and liabilities of $450,000. Using the accounting equation, determine the following amounts. Item A, owner's equity at December 31, 2011. Remember, the accounting equation is assets equals liabilities plus owner's equity. So if you plug in assets of $800,000 and liabilities of $450,000 and solve for owner's equity, you get $350,000. And then on part B, it says owner's equity as of December 31st, 2012. So this is next year, assuming that assets increased by $175,000 and liabilities decreased by $60,000 during 2012. So we use the same accounting equation. Assets increased by $175,000. Liabilities decreased by $60,000. So to keep the equation in balance, owner's equity would have to increase by $235,000. It was $350,000 before. And so it increased by $235,000, so owner's equity now would be $585,000. Problem 1-3A. Queen's Delivery Service is owned and operated by Lisa. The following transactions were completed, and they want you to indicate the effect on the accounting equation elements by stating which ones were increased and which ones were decreased. They did number 1 for you. Number 1 said received cash from owner as additional investment, $18,000. That increased an asset, cash, by $18,000, and it increased owner's equity, Lisa Dewar's capital, by $18,000. So let's look at the other 4 parts. Item 2, paid creditors on account, $1,800. If you pay something, you're using cash, so cash is going to decrease by $1,800. What you owe on account is called an account payable. It's a type of liability, and since we're paying some of that off, that's going to decrease by $1,800. Item 3, billed customers for delivery services on account. When we bill customers, that means we've done some work for them, so we've earned revenue. So fees earned, here they call it delivery service fees, is going to increase by $12,500. And notice that we provided the service on account. What that means is we didn't collect the amount in cash. They agree to pay us later. So that's going to be called an account receivable. So on item 3, accounts receivable, which is an asset, is going to increase by $12,500, and revenue increases by $12,500. Item 4, received cash from customers on account, $6,900. So you could tie this back in with part 3. Now we're collecting maybe part of that $12,500. We're collecting $6,900 of it on account. which means accounts receivable is going to go down by $6,900, and since we're collecting it, cash is going to go up by $6,900. And then the last one, we paid cash to the owner for personal use, $4,000. When you pay cash, cash goes down by $4,000, and when the owner withdraws cash from the business, that is called Lisa Dewar, the owner's name, drawing. And so that account's going to go up by $4,000. Problem 4A. Or excuse me, it's still practice exercise 1-4A. It's on page 30. We're given some revenues and expenses of Dynasty Travel Service for the year ended June 30, 2012, and we are supposed to prepare an income statement. The income statement, notice on any statement there is a heading, and the heading here is, first of all, the name of the company, Dynasty Travel Service, then the name of the statement, this is an income statement, and then the date, and this one is for the year ended June 30, 2012. And this is going to summarize the revenues and expenses for the year. The revenue consisted of fees earned, $950,000. The expenses consisted of office expense, $223,000, miscellaneous expense, $16,000, and wages expense, $478,000. It really doesn't matter what order you list the expenses in, but a lot of times you'll see those listed from the largest dollar amount down to the smallest, and then miscellaneous expense always comes last. Then they summed the expenses and got total expenses of $716,000. They subtracted that from the total revenue, which is the fees earned of $950,000. The difference, since the revenue exceeded the expenses, it's called net income, $234,000. Practice exercise 1-5A. This one is preparing a statement of owner's equity. Again, we have got Dynasty Travel Services. The owner invested $60,000 into the business during 2012 and withdrew cash of $36,000 for personal use. Nancy Coleman's capital at the beginning of the year was $250,000. So what the statement of owner's equity does is it reconciles the capital from the beginning to the end of the year. So we started out with $250,000. She put in an additional $60,000, so that adds to that. The net income for the year, which if you go back to practice exercise 4, was $234,000. That also adds to owner's equity. And then withdrawals, $36,000 is subtracted from owner's equity, and that gives us a net increase in owner's equity during the year of $258,000. And when you add that to the beginning capital, you come up with Nancy Coleman capital at the end of the year, $508,000. These financial statements that we're looking at have to be prepared in a certain order. We had to prepare the income statement first, so that we could calculate the net income, because then the net income had to become part of the owner's equity statement. And then on practice exercise 6, we're going to prepare the balance sheet. And so the balance sheet has to be prepared third. And this is on the bottom of page 30. It says use the following data as well as the owner's equity statement to prepare the balance sheet. On the left-hand side of the balance sheet, you list all of your assets. This company's assets consisted of cash, $156,000, land, $300,000, supplies, $12,000, and accounts receivable of $64,000. Total assets are $532,000. On the right-hand side of the balance sheet are the liabilities and owner's equity. We had one liability, accounts payable, where we owed $24,000, and then owner's equity, Nancy Coleman capital, $508,000. That amount came from the owner's equity statement that we prepared in practice exercise 5. When you add that to the liabilities, you get $532,000, and notice that balances with the assets. The balance sheet has to balance. And then we have problem 1-4A. And I'm not sure I'm going to have time to go through this entire problem. My videos are limited to 15 minutes. So I'll just try to summarize what we've done here. It's very similar to the one we worked in the PowerPoint. This problem is on page 40. It is Carlton Myers. On January 1st, they started a business called Vista Realty, and they completed these transactions during January. I'll just look at these really quickly. I think they're very similar to the ones we did on the PowerPoint. Item A, the owner put $25,000 into the business, so cash and capital both increased. Item B, we bought some supplies on account, so supplies increased, and a liability, accounts payable, also increased. Item C, we paid $1,600 on the account payable, so cash went down $1,600 and accounts payable went down $1,600. Item D, we provided service for our customer and we earned some revenue. And in this case, the revenue we're earning is called sales commissions. So on item D, we got cash of $25,500 and we earned sales commissions of $25,500. Item E, we paid rent. Cash went down $5,000, and rent expense. Now this is a little bit confusing because rent expense is listed as a negative. The way we're doing it in this chapter, if it's an expense or drawing and it's going to decrease owner's equity, we list it as a negative number. It's really not a negative number. It's actually increasing rent expense, but then rent expense decreases owner's equity. So we're going to change the way we do that in the next chapter, so don't let that confuse you here. Item F, the owner withdrew $8,000 from the business, so cash went down and drawing went down by $8,000. Item G, we paid some miscellaneous expense and some automobile expense. Both of those decreased owner's equity and they decreased cash because we paid those. Item H, we paid some salaries. There also cash went down and we showed it as a negative number for salary expense. And then finally, we determined that the supplies on hand was $850. We originally had $2,500, so the difference, $1,650, we must have used. When you use supplies, they're no longer an asset, so we decreased supplies $1,650, and we decreased, we actually increased supplies expense, but it's listed as a negative because it decreases owner's equity. Also notice after every transaction, they calculated new balances for each account, and the purpose for doing that is to make sure the accounting equation still balances. After any transaction, we want to make sure that assets still equal liabilities plus owner's equity. From that information, once we get our final balances, we can prepare an income statement where we're summarizing the revenues and expenses, and you'll see that Vista Realty earned a net income of $12,150. Notice that that carries forward to the owner's equity statement, and we're able to calculate owner's equity at the end of the month, $29,150, and then that carries forward to the balance sheet where we list our assets, our liabilities, and owner's equity. And remember again, total assets has to equal total liabilities plus owner's equity. So make sure you see where all the numbers on these three statements is coming from, back from that schedule that we prepared where we recorded the transactions. Okay, that ends the problems for Chapter 1. Hopefully those will help you as you work on your homework problems.